Welcome back to Face, David. How are you?
I'm
Thanks for
well,
your
Dale. Good
patience.
morning. How are you?
Yeah, pretty wild. Market's been waiting for these numbers. As Ryan said, a little warmer than usual. So, does this delay new all-time highs, or could this actually turn out to be a failing rally here? What do you
No, it's
think?
an interesting question. Today with the PPI, obviously tomorrow we got the CPI. That's
Right.
the key number really. I mean, if we learned anything from the last couple minutes, I'm in the specter sort of floating above this market, and I think preventing the market from going to significantly higher levels is the prospect of higher inflation and chronically higher inflation. And that's been an issue that's come up a number of times here, but I think this week is going to be vital. We're all about trying to sort of pick out that first Fed rate hike if and when that's going to happen anytime soon. And so the short answer for me is yes. I think inflation remains stronger than people would like. I think, the Fed has made it clear they're data dependent. And so if the data shows that it's still an issue and that rates need to stay higher for longer, I don't see how the market takes that as a positive outcome. I think that puts a ceiling on this market until we sort of move into this next phase, which doesn't seem to be starting anytime soon.
So, I believe I heard you say the word hike. So we've already come off. We're re-rating this market number to number, Dave. Even though the moves in the market, are going on their own, but re-rating rates, from six cuts to maybe none to
Yeah.
now, then last week maybe two or three. And you actually brought up hike. Do you think there's a possibility the Fed might hike sometime this year?
I mean, it may be, and the fact that that's even a question you would ask and not be laughed out of the Zoom room is telling, I
Yeah.
think, because
Okay.
I mean, do I think it's likely? No. I mean, I would say
Yeah.
generally what the game plan most likely, I mean, barring some huge aberration in the data, would be higher for longer. The first cut is just much further down the road. Later this year, you have a couple cuts that go into 2025. And then you reassess, and by then you've had a lot more data to sort of crunch on. The market really, if you look at like the Fed Watch tool, they're not really pricing any sort of high likelihood of a rate
Right.
hike. But at some point, right? I mean, if the data is very overheated, then that has to be a conversation that's had. But the fact that that's sort of the spectrum of outcomes, as opposed to are we going to have
How
seven
many?
cuts or five cuts,
Yeah.
which is what the conversation was not too long ago. I think that
Yeah.
tells you a lot about how we're sort of rethinking this trajectory. The glide path has changed pretty dramatically.
So could the 10-year make take out last October's highs without the Fed hiking and the market hikes for them, taking them back to over 5% on the 10-year yield?
So that is actually a really good way to think about it, right? And I think a lot of people, and again, oversimplistically, think of interest rates as being managed by the Fed, right? So what does the
Yeah.
Fed do that the 10-year does X, Y, Z?
Yeah.
And you're right. I mean, remember, the Fed's just controlling the short end of the curve, and I don't think they need to change much. I think the longer that they would delay any sort of rate cut, sort of sends the message that they're intending for rates to remain higher. I think the market can naturally push the 10-year yield much further than it has so far. From a technical perspective, I mean, as a trend follower, the trend in the 10-year yield remains upward, right? I mean, it
Yeah.
remains positive. The trend in bond prices remains down. And you can draw trend lines off of the lows to track that. You can just simply look at the highs and the lows and the fact that we
Yeah.
keep making forward progress. So the offense is on the field as far as I'm concerned, rate wise.
Put a
And I think,
weekly put a weekly up on that, David, and
yeah.
you'll see that I see a potentially incomplete pattern. We had
Okay.
our highs in 22, late 22, and then
Mhm.
another high in late 23. And a three drive formation would imply taking out the 23 high and then maybe peaking. Three
I,
drives to a top.
yeah, I think that makes a ton of sense. And the momentum, again, which, just basically tracks the trajectory of the data and what it's doing, says that there's
Yeah.
room to go, right? Which means there's more upside to be had. Very much a possibility. And again, I don't think a lot of people have been thinking about what does that mean when the 10-year yield's above 5%, or at least we haven't been thinking that way recently. It's been more, thinking of this rotation lower and how rates come down and what that means for
Yeah.
growth stocks. If we remain the alternate scenario, that's where a protracted decline in risk assets would sort of play out. That's where stocks would sort of begin that C wave that we haven't seen yet. That's, I think,
Oh,
what could
okay.
start it.
All right. So why don't you tell people, a lot of people aren't really aware of that bearish outcome of the C wave. Can you, put up a chart and explain that count to people so
Yeah.
they, yeah, okay.
Yeah, so there are a couple ways to think about it, right? But I've highlighted just these two orange areas to show the similarities between what's happened from the March peak to where we're at in mid-May with what happened in late July to Labor Day of last year. And if you think
Any
about what
reason why you
happened,
used orange? I mean, without getting
well,
political.
no, yeah,
All right.
I have to go neutral as much as possible
All
here.
right,
So.
go ahead. I won't say that joke. Anyway, go ahead.
No, so if you look right back in the summer of last year, we made a new high. We came
Yeah,
back and broke briefly below the 50-day moving average. We actually broke briefly above it, but then we made this lower high. And that was
yeah,
really the first major lower high since the March low earlier in the year.
right,
The
right.
momentum really stalled out. So instead of getting up to the overbought region like we did there, it's actually down around 60, which suggests that there's a lack of momentum pushing things higher. And then we
Yeah,
break down through the 50-day, and that was pretty much it. We had another 2 months of a downtrend of more further lows. We've
yeah,
kind of done everything up until Labor Day here. We're kind of right at the same amount time wise, distance
yeah,
wise, where we made a new high. We pulled back briefly below the 50-day. We then went briefly back above it. And no guarantee that we're going to get that after. I mean, that would be I mean, it's possible, but I mean, that's not necessarily what happens, but it shows you how that second peak, that lower peak, how it often feels very bullish, right? I mean, I think there's a lot of people very much getting drawn in by the upward momentum off of the
yeah.
April low. The reality is that first kind of bear market rally is usually, I always say it's sudden and seductive. And I think both of those things we've seen. So the way that you see that this is happening, the way that you get out of the way of this kind of move is the quick move back below the 50-day moving average, the momentum deteriorating. And that's kind of right where we have not seen that yet. And I think that's what I would be looking to see. And if so, that's when I think you need to really go more risk off in your thinking and in your positioning to cushion yourself from the fact that you might have more of a protracted decline.
Okay, is that the C wave, or do you need
Yeah,
a
so the
weekly?
way to sort of label it, a couple different ways to think about it, but a common, sort of move is you have a big move higher, and then you'll have a three-wave structure, right? So like an A, B, and then C, and then you sort of make
Okay,
a lower low. And often what
okay,
happens here is the length of the first wave lines up very well with the length of the third wave. So you can see here they're very
yeah,
similar sort of moves and structures. What happened here was you ended up rallying to a descending 50-day moving average and failing. So what I like to think is after you've had a pattern like that, you wait to get validation that the downtrend is over. And you saw in November, you really had all the signals gapping off of the lows, back above moving averages, momentum getting much stronger. And so here, when the RSI actually got overbought again, was actually a sign that we were in the clear and that you were in a much stronger market environment. So I'd be looking for that sort of validation. If we would get another leg down, that's what you start to look for.
would you buy a break in the miners if we get one?
For
Uh,
sure.
yeah, they've really been, people, even physical precious metal bulls were completely frustrated in March with holding their gold share positions. Were down 40%. Well,
Oh yeah.
they certainly got it back in spades. They're probably even now.
Not bad. And again, I
Yeah,
just went to the Money Show last week, and people were very surprised to recognize that gold has outperformed the S&P and the Nasdaq year to date, which is
yeah,
not something we're used to thinking about or accepting as a reality, but
yeah,
it's true. So the precious metals trade is actually quite strong. Really coming out. I mean, March, April is really where it really
Yeah.
started to materialize. But I think physical gold is a strong setup, and the daily charts are encouraging. Here you have the GDX
Yeah.
testing the highs from 2023. There's a bit of a pennant pattern, which is when you
Yeah.
have a big move higher, and then this sort of consolidation, this narrowing of the range of lower highs and higher lows. That pattern broke out sort of end of last week. That was on Friday when we popped higher. So overall, the setup is actually quite constructive.
Y-
And then physical gold, I would say the same thing. You have sort of that the weekly chart of gold is what's really. I mean, we looked at the weekly chart
A
of the
cup and
10-year
handle.
yield. Same sort of thing. I mean,
Yeah.
if you look
Wow.
here, I mean, it's just this incredible base that we've broken
Breakout.
out of. And
Yeah.
if you study market history, bases that are multi-year bases, which is this sort of flat rectangular pattern, and then when you finally
Yeah.
break out, that's when, significant gains can happen after that point. And one of the early technical analysts for me, Alan Shaw was one of the first, sort of a couple generations before mine. He used to say the broader the base, the higher in space. So you have a
Oh,
big
see,
multi-year base
Louise
for gold.
Yamada takes credit for that.
Yeah, and
Uh,
Louise worked with Alan Shaw for years and years. That's
oh,
all
no
coming from the
wonder.
same place.
Okay. And
That's
I thought I made it up until now. So, anyway,
yeah, yeah,
I guess I don't have any original thoughts. But you know what is interesting about this gold rally? I'd like your thoughts on it. Is that gold rally happened in the face of a rising dollar and rising yields, which
yeah.
tells me there's a new regime in gold, that
For
that
sure.
doesn't
And I
matter
would say that's
anymore.
one of the great things. I mean, for me, of course, with a lot of bias, I would say it's one of the benefits of technical analysis and charting, which I know is core to what you guys are doing every day.
Yeah,
Because there are a lot of narratives about what gold should do given the
right.
dollar or given rates or given risk assets.
Yeah,
And the reality is, if gold's going up, gold's going up. And I think that
great
definitely, I mean,
point.
something is very different from, and we've seen that not just with gold and the dollar and rates, we've seen that with um, uh,
Copper.
leadership in the markets. We've seen that with sectors that are leading growth into value, value into defensive sectors. So we've seen plenty of rotation, I would say, for sure.
Your view on the meme stocks being resurrected from a few years ago?
Oh, the meme stocks, yeah, like the AMC and GameStop and all of
GameStop.
those.
Ryan said that it. I said I don't know what it means, and he said it means that the Fed is not tight enough for this to be happening again.
Well,
Um,
certainly, right? I mean, if it's a rate tightening cycle, it certainly seems like this is not the time when you would have it. And these are bull market things that you would experience, right? Sort
yeah,
of a
right.
wild west, everything's going up. I mean, again, for me, I started in June of 2000 in the industry, so I'm coming off of the late 90s. That's where I first learned about investing, where it was just sort of like, let's, throw a dart at a dartboard and see which stock is going to go up 10 times kind of thinking. And that is very much the mentality of these sort of swift and sudden moves pushing to the upside, and taking advantage of the fact that there's sort of this built up pressure that could allow
Yeah,
these stocks to gap higher. Very counterintuitive based on what we're seeing elsewhere.
yeah. I hear it's not. It's institutional that's participating in this. A few years ago, like when that movie Dumb Money,
Yeah.
it was just retail, and the
Well,
and the big money was fading it and getting hurt.
Well,
So
I mean,
they're
the whole essence of these, right? I mean, and that was the original sort of meme stock era, for lack of a better term, where institutions, hedge funds being caught short, and
right.
then getting pinched on the way up, getting having a getting burnt as the price popped higher. You get caught short, and you have to roll over, and it's a huge short squeeze. Now, I think the second time that happens, I think people are sort of they've seen this play before, they've seen this
Yeah,
movie, and they get the
right.
idea of how you could possibly bet it. The
So
question, I
they're
mean, the
trying to
question with any of
squeeze
these moves is
retail.
the sustainability of it for sure.
Yeah. Do you have a dollar view, Dave? I'd like to know because it's easy to have no view, but technically, really kind of rangy here.
It is the definition of a range-bound chart, and I would highlight. I
Okay.
actually didn't move this shading over, but the reason why I had that shading right here, this purple shaded area,
Yeah.
one of the things we've been talking about is the 107 level. 107 is the
Yeah.
peak from fourth quarter of
Right.
2023. That's
Right.
where we rallied up in the summer. We sort of stalled out there and then, almost made a new low going into year end there. We've
Yeah.
basically retraced 100% of the way back up to that point. So, from a technical perspective, this is really more of a range bound chart. And when you have this sort of congestion area, you expect it to be very difficult for the dollar to get above there. But I would also say if and when the dollar would push above 107, that would talk about a regime change. I always call it a change of character. Dollar over
Okay.
107 all of a sudden tells you that we're out of this range. This range that's been going is now broken. And from a technical perspective, we're in sort of a new era to try to dissect. I think dollar over 107 is not a great thing for
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 anything.
equities for the S&P and the Nasdaq. So in this
Yeah.
environment where the S&P and the Nasdaq have been regaining some momentum, they're sort of approaching all-time highs again around 5250. You're looking for warning signs, things that would tell you that's unlikely. Rates popping higher, dollar strengthening. These are things that would tell you, okay, this is something different, and maybe it's unlikely we get a sustainable move higher.
Okay. Would you have to wait for on the flip side of the coin, closes under your moving averages would, or it's easier to come up with um, a bull case than it is a bear case. What would give you a bear case in this?
Right. So from a technical perspective, there are a couple things to think about. Number one, we're right above moving average support here. And most recently in early April, we bounced off of this is the 50 and
Yeah.
200 day kind of clustered
Right.
together. So
Right.
breaking below there is a concern. And I would say that unlocks a potential return back to the lows
Yeah.
from December, right? I mean, that would sort of be the next major level down, probably 102, 102.50 or so would be the March low would be sort of the immediate support, but it
Okay.
really, sort of suggests that we're rotating lower. Another thing is a trend line off of these
Yeah.
lows sort of
Okay.
ends up right around that same place. So you have what's called a confluence of support right about there. The other
Okay.
thing is, if you looked at what happened in September, October, November of last year, this blue dashed line is a 38.2% retracement. This is from the 2022
Wow.
rally when the dollar
Yeah.
was sort of like the dollar strong and everything else
Yeah.
weak year.
Yeah.
That look at that measurement, 38.2% of the way down is right there. That's actually served as resistance a number of times. And I would
What a
say,
big
well,
pivot.
for sure. And breaking above there was meaningful, but then when we failed to hold it, that was a real danger sign suggesting
Yeah.
weaker dollar in Q4. So having a similar sort of move here,
Around the
could be
105
kind of a
level.
danger sign. So we're
Yeah.
right near levels where this feels like a weaker dollar move next.
You know what a classic example of looking left as a trader. Look how far back Dave went with this, and look how many hits. Really great look there, David. Anything you want to wrap it with that you came in here today and I didn't ask you about it?
Oh, thanks, Dale. No, I would say, I mean, generally speaking, I mean, this market, I would say for the equity markets certainly are conflicted. You have strong, the price action from mid-April has been strong. The breadth conditions have become incredibly positive. So these are the market advanced decline lines for the New York Stock Exchange for the different cap tiers. They've already made a new all-time high, right?
Yeah,
So
and
the
that's
AD
bullish,
line on the New York
right?
Stock Exchange has already
Yeah,
broken out. So the S&P is below, its all-time high, but measures of breadth are actually quite constructive here. The challenge I would say from equities is what's driving this is it's not, Meta and Tesla and Apple. It's, Southern and Nextera Energy and a bunch of utility stocks and other things as well. And that's not, I
interesting.
mean, in general,
Defensive.
that's good when stocks go up, but the types of stocks that are really starting to do well are defensive sectors like utilities, like consumer
Yeah,
staples, in a way we've not really seen for a while, and certainly off of the October low. So the character of the equity markets is certainly changing, and I'm concerned by the lack of upside momentum in those leading growth names, those mega cap
yeah.
names that have the ability to move the S&P to new all-time highs. I think there's still more to prove in some of those areas.
You did it again, David. Crystallize a lot of things for people watching you today. and your charts are so clean. No coffee stains on them. Oh, that's when we had chart books and stuff. Okay, but really nice looks and analysis, and I really appreciate over the years you coming here and really giving 30-minute discourse of tech 101 and keeping it simple for people to understand. Really nice.
Happy to do it,
Appreciate it.
Dale. Pleasure.
Yeah, and appreciate it. So people could find you on stockcharts.com, and you still have your own service going as well.
That's right. Marketmisbehavior.com is my own website, and we feature some of the content I put on Stock Charts, my own YouTube channel, lots of places. So look forward to engaging people there anytime.
Yeah, and you could DM David if you have a question. I'm sure he'll respond on X at David Keller CMT. Dave
Yeah, at
Keller
D Keller
CMT.
CMT.
Okay. And Dave, thanks so much. You have a great trading season coming up here. And it's always, for me, I learn every time and reinforce good habits every time I talk to you, my trading warrior brother. Thank you.
Great to chat with you, Dale. Have a great day, great week. All right.
All right, Dave Keller, everyone. So follow this guy. You want to learn about technicals and the things that he sees. I think he gave us great looks. People are thanking you, David. And everyone, good hunting today. Good luck. Remember, don't just count your pips, count your blessings. And we'll see you tomorrow. I'll see you tomorrow. You could join the team in, looks like about 19 minutes. And I'll see everyone for the Consumer Pain Index tomorrow. So good luck the rest of the day. Get inside ForexAnalytix and surround yourself with traders better than you. Adios, everyone.
Hey traders, this is Blake Morrow with Forex Analytics. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.